The race between the hare and tortoise is an age-old story. The hare loses despite being swift, and the slow and steady tortoise wins the race. The lesson here is patience and consistent progress can top overconfidence and doing too much. This applies to investing too. For that, let's talk about active and passive investing. Active investment in mutual funds includes a fund manager who actively decides what investments to buy and sell. These fund managers come with investing experience and are responsible for stock picking based on market trends and instincts. Their goal is to outperform the market indices and give you more returns. Passive investing, on the other hand, is when funds mirror the performance of a specific financial index, such as the Sensex and Nifty index. These are known as index funds. The fund manager, who's the hare in our story, is confident that they can outperform the market. Given their professional skill and market knowledge, they should. However, the data says otherwise. The SPIVA, which is the S&P indices versus active funds India, conducted a study on active and passive funds. Their report shows that in 2023, 51.6% of actively managed equity large cap funds underperformed the S&P BSE 100 index. Furthermore, when we compare returns over long periods, 87.5% of funds failed to beat the S&P BSE 100 index over a 3-year period, and 85.7% and 62.1% of funds failed to beat the index over 5 and 10 years periods respectively. Now let's come to the equity mid or small cap funds. 73.58% of such funds failed to beat the S&P BSE 400 mid-small cap index. The data shows a similar trend over longer periods. Mid-small cap equity funds over the 3-year, 5-year and 10-year period have lagged behind index returns by 60%, 58.14% and 75.41% respectively. In the composite bonds category, over 95% of debt funds failed to beat index returns over 1 year, and over 99% debt funds failed to beat the S&P BSE India Bond Index. When it comes to ELSS, the S&P BSE 200 index has beaten over 75% of funds over the last 10 years. However, it's a disclaimer to all investors that past performance does not guarantee future returns. 2 decades of S&P data does not tell us how the market would perform, but it certainly points out a pattern over the years. In the active versus passive debate, passive has outperformed in each and every category. What would you choose? Steady passive funds or underperforming active funds? For more money matters, don't forget to like, share and subscribe to the channel.
Investment in securities market are subject to market risk. Read all the related documents carefully before investing. For more information, visit kuvera.in.